Morning, lovely traders. Quick update on the markets. I'm feeling a lot better. Thank you very much for asking. And we'll go into some of the markets. This is going to be a 5-minute update. I'm not feeling that strong, but I'm feeling good enough to do another 5 or 10 minutes. Let's go through from natural gas and we'll go across the tabs from right to left as usual. Actually, you know what? Change of angle. I'm going to switch across the other computer where my Discord private members group chat section is. The reason I'm doing that is because I want to go through a few of the chats with you and just show you what we've been talking about, and also describe to you how I traded this natural gas trade over the rollover, which I was just talking about earlier. I can only show you my specific example. It'll be different for every single person, depending on the way you trade, depending on your broker, depending on the instrument that you trade. So I'm going to go into my Discord, which is on this computer. Not only natural gas, but there are a few interesting developments on stock markets and on currencies and even on gold. So let's go across there right now and we'll carry on the other computer. Right, I'm now on the older MacBook Air. This will be an interesting experiment for those of you who are interested in technology. This older MacBook has a lower resolution camera and it's also got a poorer mic. So if you're a tech geek, you might be able to spot the differences in picture and sound quality. Let's go to my Discord channel and I want to show you the sorts of things that we've been looking at, particularly on natural gas. Now here's natural gas. Now as I was saying in the previous section of this video, depending on your broker, the rollover will be different for everyone. Not only depending on the broker, but depending on how you trade, what positions you've been on, what instruments you're trading. Some of you, as I said earlier, are trading oil and UNG and coal. Some of you are trading the futures contracts. Some of you are trading spot or continuous contracts or prices. So it'll all be different. And some brokers roll over at the beginning of the week, some towards the end of the week, some over the weekend prior to the NYMEX change, and so on and so on. So I happened to roll over yesterday. That's why I'm talking about it today. All right, so this is the discussion room in our Discord. And if you want to join this, there's a 14-day free trial. There's a link below. There are several channels in here. We have the discussion room where we chat together as a community. I put up some ideas and thoughts, not necessarily trades. Then we have a trading room where all my live trades get posted one by one. And we have a trade log where all the logs of previous trades are kept. And they're there for analysis and reminders if you've forgotten what we're trading. And there's also a resource page with free things for members, like discounts on TradingView charts. There's a link to my broker at Black Bull Markets. There's also a link to the bookstore that's on my website at ArcisFX. Once again, there's a link below. So I'm not going to go through all those, but I do want to talk about this discussion that we had regarding gas. And Sanjay in our chat said, sounds like your broker put you in with 20 cents, in this case, below the current price of the new contract. You're talking about the rollover. So here it is, and we'll look at the barchart.com chart, and we'll then go across to the other charts. And what I wrote here was when it rolled over, the January contract was 288 on the NYMEX, and there's the NYMEX chart, taken from the January contract on barchart.com. I have to backtrack a little bit here. So the question from Sanjay was, on your roll, you had an unrealized loss of 21 cents, which got realized, right? Long 295, closed rollover at 274, and then a new long position from 288. So he's saying, did you lose 21 cents? Actually, I lost 14 cents. I got rolled out of 274 and I got rolled in at 288, not 295, where my original position was. So it was a 14-cent loss, which is annoying because the market then promptly carried on rallying up from there. I'm going to go to the 15-minute chart just to show you the rollover. And there's the rollover gap there. So we closed at about 274. That's where my current positions were, long from 295. And I got rolled in at 288, which is where this candle opens after the rollover. This took place at 10 a.m. yesterday. Considering that the rollover was actually today at midnight, I think it is. It was a little earlier, and normally they're on the same day, so I don't know actually what happened on this occasion. But instead of getting rolled in at 295, I got rolled in at 288. So an effective 14-cent loss. We're now at 296 as of making this video. So we took that 14-cent hit, but we've made 8 cents back of that already. So we're a few cents down on this trade. No problems at all. And that's our position, basically. Long from 288. We're now at 296, so we're in a little bit of profit. We got in at the end of that rollover candle, and we're up there now. And we've broken above the support. Now, I know there's a lot of confusion on this rollover, and there was last month too, and it's because of the different timings and the way brokers deal with it and the contracts that people are in. So you may have been left behind on this trade, and I'm not saying this is going to continue moving up. My target's $3.50, but it may not actually be going up. It may be going down. I don't know. I think it looks quite positive, having broken and closed above this high on the 4-hour chart. My suggestion is if you didn't manage to get into this trade, try and look at something like this, and I'll put one of these sort of positioning tools in on TradingView here. And I would rather wait for a retracement back to these highs over here, possibly that one that we've just broken above. And if you were to take a long position, I would say probably from somewhere there, like that. And let's just adjust this. So this is the 4-hour chart. I want my stop loss not below that low necessarily, although that's a safer place to put it. That's where mine is. I don't have a stop loss, I have a hedge. But if you're trading this or day trading it and you want to put a decent stop loss, you're not hedging, you don't want too much risk on this trade, I would say put the stop loss beneath these lows here as this is forming a potential inverse head and shoulders. I wouldn't be surprised if the price comes back to test these lows but avoids that low, which would then create this head and shoulders. And I'll try and draw this out for you. And that would look something like this. It's a very rough drawing, something like that. And then down to another shoulder. Might be a bit skew, I don't know, but let's just try and estimate it, and we'll just take that line back up to the top there. That's obviously the next resistance level at that swing high. It's an important pivot point, and it's also where the market turned around, where all these moving averages are. So there's the head and shoulders. It is a little bit unpleasant and badly shaped, but you get the idea. So we want our stop loss below that right shoulder. So let's go back to this trading tool here and put the stop loss below that left-hand shoulder, probably at around 278. Let's make it 277. Stop loss at 277. I don't like putting stop losses on 8s and 2s. It could be just superstition, but actually the market does seem to be attracted to 8s and 2s as price magnets. So that's the sort of thing we've got going. Potential inverse head and shoulders. If you didn't manage to get into this trade, this is what I'm trying to say. That's a good entry level there. We're trying to set up a sort of a trade here. Where would we want to get into this trade? We'd want to get in as close to the lows of the left-hand shoulder as possible. That's at about 280 to 285. Interestingly, the same number that we've been looking at for weeks and weeks now as our potential reversal area. We're right there now. So this could be the reversal area that we were looking for all along. And maybe it's just worked out perfectly. I don't know. But we want to get in somewhere near this left-hand shoulder. So we're going to put the entry price a little lower, probably down to about, I think 285 actually is a good number. Let's stick with our number that we chose long ago. And then the stop loss needs to be below there. Now you could either put the stop loss beneath this level here, beneath the head, like that. Let's leave it there for now. And then the target, we want to be back at the top of this channel. Now there's a downward sloping channel line here, but I think we could go higher, back up to this previous high. This level here is about 353 to 355, and this high here is about 364. So somewhere between 350 and 365 is the target for this trade. And let's go back and have a look at that. Now, that's a perfect trade setup because we have a very, very good risk-reward ratio of 4 to 1. Now, we could reduce that risk-reward ratio by raising the stop loss, reducing the amount of risk on the trade, and we could actually increase the target as well, but we don't want to do that for now. If we did raise the stop loss a wee bit to below the left-hand shoulder, that improves our risk-reward ratio to almost 10. So I'm just going to leave it there for now. I'll leave it for you to decide if you're interested in taking this trade. You could put it below the left-hand shoulder or beneath the potential head. We don't have a head and shoulders here. I'm just making this all up, as you know. But this is the sort of thing that I try and envisage prior to it developing. So if that pattern does form, I already know how I want to approach it. If that pattern doesn't form and we just carry on moving up, and I'm not in this trade, which I am, but if you were not in this trade and it just kept on going up, then you'd have to readjust your strategy. So let's leave it like that for now. I'll leave it for you to think about where you'd like to put your stop loss, below the head or the left-hand shoulder, and the target either at 350 or at 360 to 365. But if I increase the target, the maximum that we could get out of this trade safely, I think, by increasing the target to 365, by reducing the stop loss to below the left-hand shoulder, that gives us an 11.45 risk-reward ratio. I think in anyone's book, that's a decent trade. You'll very rarely get risk-reward ratios of that magnitude, so I think this is fantastic. And let's see how this plays out. Let's go back to the Telegram. I was planning on talking about other things as well, currencies and metals and stocks and everything, but I'm just going to skim through the charts and tell you about our new positions. So we have a long position on VIX-Y at 1742 at the current price. That didn't move at all yesterday. Looks very interesting, actually. Let's just quickly look at that while we're here. It's going to be a bit of a disjointed video. This is the day chart on the VIX-Y. Let's go to the 1 hour chart. And what becomes more fascinating here is looking at the 1 hour chart. Look at this. We ranged between 17.53 and 17.37 the entire day yesterday. That's incredibly unusual. I've never seen it before on the VIX that I can recall in any event. And I'm wondering if this might be the reversal candle. Yesterday's candle, it's called a full stop, or maybe a morning star candle, depending on your nomenclature, and that's where we are at the moment. So we're long on VIX-Y at 1745, roughly. We have no positions on Bitcoin, although I think that's still looking weak. We have nothing on the 10-year yield. We're short on sugar, that moved down a bit yesterday. We're short on London cocoa futures, that's been going sideways for more than a week. We have no positions on wheat. That's still looking increasingly weaker as we move down. We've now broken key support significantly and fairly violently, and I think we've got a long way for this to go down. Next target for wheat is 500 cents per bushel. We're long on WTI from the low of yesterday's candle, roughly. and we've moved up a little bit today. I'm aiming for oil to move back into the mid to high 80s, maybe $90 per barrel. Going across to metals, we have nothing on any of the metals except now for gold, which we just shorted. Now, I rarely short gold, and I don't think this is a great trade setup because we obviously still have a dominant uptrend. But look where we've reached on this uptrend, and I'll also tell you another reason why I'm looking at short gold and short stocks, not just because I think they're overcooked and overextended, but here's gold. We'll come to stocks in a short while and the reasons why. Look where we are in gold. We're at the 78.6% Fibonacci, not quite, but almost there, and we just sort of stalled there on the daily charts. But if we go to the 1 hour charts, you can see in more detail that we formed this wick high here. We haven't managed to break it. We tried, fell back down, tried again for the second time, fell back. We're trying for the third time now potentially. And on the 4 hour chart, you can see we've had quite an extended run. What I'm going to do is put in a channel line here. We have a beautiful upward trend line from the bottom, and let's just draw that out into a channel. And you can actually see that we have a pretty perfect channel here. The danger is, of course, we'll go to the top of the channel. If I pull the scale down, we can estimate where that might be by the time we get there, and that would sort of trickle up. Let's just say something like this. Again, I'm drawing with my mouse, so it's pretty messy. So if we did sort of move up to the top of the channel, that would take us up to about 2044. Remember, the all-time high is at 2076, so still not quite there. I think we may not get there. I'm not too sure. But when you look at this 4 hour chart, you can see a decrease in momentum. You can see a stalling out. No doubt there'll be divergence on the stochastic and the RSI. And I just think that we're going to see some strength creep back into the dollar. We talked about this yesterday, and I put some tweets up in X and also my private members channel. Anyway, that's what we are now. We have a very, very tight stop loss. We have a downside target, believe it or not, of 1920. Let's go back to the day chart and just clean this up a wee bit. So our target is at 1920. Now that's down here. We're back to the day chart, and I'm going to have to change Fibonacci's from the bottom to the top. Sounds like the words from a rap song or a pop song, from the bottom to the top. So there we go. There's the Fibonacci from the bottom to the top, the current top. We may form a higher top, I don't know, but that's where we are at the moment. And if you look below us, you can see with the Fibonacci levels there, the 38% is at 1940, then 1920 is the 50%, and then 1890 is the 61.8%. That's the key and major support at around 1890. I think, and it's possible we could even get there. I don't think so, but I think we could get to 1920 or 1940, 1950. We're now at 2015. So it might be that we could get a pullback down here. Maybe 1940 makes more sense. That's where all these moving averages are. You can see the 200, the 50, and the 100 are all in confluence at that price. It's also where the 38% fib is. And if we did move down there, we could actually form something like a double bottom and a move up. Now, that's not a very well-shaped drawing. Once again, I have to draw with my mouse. But imagine that we sort of get a move up, a double top there, maybe a double bottom, and then forming this sort of parallel sideways range and then a breakout through the top. That's the sort of thing I'm looking at. Now, why do I think gold might weaken from here? Well, simply for one reason. I think we're seeing that the dollar index may actually want to bounce here. Let's go across to the dollar index. And here it is. Now, this is a super key level. I put this up in Twitter and my members area as well. But it's a really, really important support level. And people are saying, well, we're probably not going to find support. The dollar's going to move down. It's moving down firmly. The momentum's downwards. The trend's downwards. Why on earth do you think this might bounce? Well, I think we're probably a little overextended to the downside. But also, I don't think the market's totally determined and totally decided which way it's going to go. And that includes interest rates and bond yields and pauses or no pauses, hikes or no hikes, what central banks around the world are going to do with their own currencies, which of course affects the dollar and the way the dollar trades against those currencies, other fiat currencies, and gold. So I think we may be still ranging a little bit on currencies for another month or two, which means we've got a potential chance for the dollar index to bounce up, which would bring gold down potentially, and the euro and the pound and the Swiss franc and the Aussie dollar and all those sort of things, and potentially also put pressure on commodities. We could see some pressure on natural gas and oil and things like wheat and sugar and all the other ones. Now, just looking at my charts over here, just looking at the major currencies, I think we could perhaps switch across to those to build a stronger case for this potential dollar weakening. Let's start with the pound, some of the major currencies in the dollar index, and go to the pound weekly chart. This chart's completely naked, as you can see. Now, if I just draw a line in where we are currently, you'll notice immediately that it's a key resistance level on the pound weekly chart. It was a resistance level over here. We touched it 3 times. We touched it 2 or 3 times here as a support level, and again over there, and again over here became resistance again, resistance over here, resistance over there. It broke up, became support. We fell back down. It's now resistance again. Pretty key level on the pound. Now, let's go across and have a look at the Fibonacci analysis and see if this will give us a clue. I'm going to go back to the day chart for this. So let's just put in a fib from the top to the bottom. I think this sort of thing's useful for you to see the way I think, and I'll include a lot of this in my training course when that comes out. But I think it's pretty useful for you to sort of understand how a professional trader thinks about the charts and what we're looking at across a wide spectrum, a wide variety of different instruments that I trade. The reason I swip and swap between charts all over the show, and I've got so many all over my office, is because I'm watching all sorts of things, probably about 36 to 40 different instruments that I trade. And so I've got to be able to switch between charts and also get a feel for the sort of main things I want to just put on my charts, the things that give me the big feel, the big picture. I'll put on a few moving averages, the 20, the 50, 100, and the 200. I'll put on some fib levels and basically just channel lines and horizontal lines of support and resistance. That's what we've got here. This resistance level here, this weekly resistance we looked at earlier, it's bang in the middle between the 618 and the 50% fibs. So we may have to touch that 618 first before this moves down, which means the dollar index may have to drop a wee bit further. It's already just broken beneath that previous support. So perhaps we'll even just get down to that 61.8% Fibonacci first. That's about 102.50. We'll keep a very close eye on all of these majors because I want to be buying the euro and the pound going forward, and buying more gold and some of the other things affected by the US dollar. Let's have a look at the Euro weekly chart very quickly. Interesting, while we're on charts, we had this drawn back in 2021 and I didn't realize it was still there. Look at that, head and shoulders pattern, and look at the move down from there. That's a classic textbook study of something that I put in, well, almost 3 years ago now. In fact, it's exactly 3 years ago I drew this on these charts. And there it is. Look at that. Perfect example of a head and shoulders. This is the Black Bull weekly chart on the euro. Now let's have a look. Let's put a line in. The first thing you do every time is just see where we are at the moment, put a line straight across, and then just shift your chart out and see if there's anything significant there. And of course, as we look at it, straight by eyeballing it, keep things really simple. We're just trying to eyeball the charts. We're not trying to be rocket scientists or nuclear physicists. We're just trying to look at the broader, bigger, simplest picture of the charts and make a sort of a snap judgment and say, are we at anywhere significant on the charts? Is it a support or resistance level? Are we likely to get a reaction where we are at the moment? If not, where's the next level that we should look at? Look where we are at the moment. We've broken up through this previous low. We've got up to these support levels. Now, it was resistance over here, support over there, resistance here, support all along here, and resistance over there. So it's an interesting level and a potential level for the euro to turn around. Now, as I did with the pound, let's put on a Fibonacci and we draw it from the top to the bottom because we've moved down and we're bouncing back up again. And look where we are, exactly at the 61.8% Fibonacci. And look at the price action that occurred on the previous visits. Now, remember, this is a day chart, so this is going back a week or two. But a couple of weeks ago, we had this bearish reversal candle. We got through the top, we broke higher, formed a wick high. The body of this candle is bigger than the body of the previous bullish candle, and then the trend began to move down. That's this candle here. That's called a dark cloud cover candle, not a piercing pattern. Piercing patterns when you see the same candle from the bottom moving upwards. This is a dark cloud cover candle. We move down, back to the support level, back up again, and we're back where we are, where this dark cloud cover candle started to form. So we're at the resistance level, although there is room for it to go a little further, and we're at resistance on the dollar index. And because of all of that, and because I think these markets might be a little bit choppy going forward into the next few weeks, I think we could see the dollar rallying a bit, and that might bring down the price of gold, the price of the euro and the pound. Unfortunately, that would push up our dollar yen trade a bit. I'm not going to talk about that one today. Right, going back to our Discord discussion channel, I don't think there's anything else I really want to point out in here. We talked about a few things like the DXY. There's some mention of that there. What's next for the US dollar? Go and check that out on YouTube on my channel. I've sort of described what I've just talked about now. There's a short video on that. And then there's a whole bunch of stuff from Wall Street Journal and various other articles that I've shared. Talked about London cocoa. There's an article I put up from the Wall Street Journal about OPEC in here as well. I'll just read the first sentence. A scenario in which a group of major oil producers known as OPEC Plus decides to flood the market is seen as a long shot, but still something to consider given that history has been known to repeat itself. There's talk that OPEC might want to flood the market as demand drops off. They know it'll reduce prices, but they'd rather get volume out there and make some profits from the volume rather than the extra price. And sometimes, and they have done it before, actually when the price of oil dropped below zero. And it's not only to maintain production volume, keep their machines running, keep the bank accounts ticking over, but it's also to keep smaller players, smaller countries, smaller producers out of the market who can't afford to sell at such low prices. So there is something about that that's pretty interesting. And we will be talking about this. We have a live stream tomorrow. I want to bring your attention to this. If you're interested in oil and gas, Energy Rogue, the energy experts, are hosting me on their live stream tomorrow. There's an invite on this channel. Go and have a look at upcoming live streams on the homepage of my channel. Make sure that you attend that event if you're interested in oil and gas, because I think this will be pretty interesting, considering all this talk about OPEC Plus potentially reducing the price of Brent crude oil to keep the bank accounts flowing, to keep the pumps running, and also, as I said, to keep smaller competitors out of the market. We talked about this divergence on the S&P versus the dollar. Normally when the S&P goes up, the dollar goes down. On this occasion, and currently, let's go and open that in the browser. Currently, we're seeing the S&P going sideways, and that's not the unweighted, non-weighted S&P. That's the actual S&P 500. If you take the Magnificent 7 out of here, this is actually going down, and you can see the dollar index has been moving down. But the stock markets have been moving sideways. Normally, when the dollar index moves down, stock markets move up. That shows some degree of weakness in the stock markets, and actually some reticence for traders to buy stocks and to go into risk assets when things are perhaps not as rosy as they could be. There's the invite to my live stream. If you go onto YouTube, it'll be right on the homepage. Go and check that out. And then there was an article again from, I think this was from Bloomberg this morning. And I'll just go through some of these headlines. And these are sort of articles that I post up in my live stream. Good morning, what's happening now? Barclays may drop more than 2,500 investment banking clients. Some traders are betting on large Fed rate cuts next year, up to 250 basis points. US IPOs are making a comeback. Inflation in the UK fell to a 17-month low. And I'm sure the POMs will be very excited about that, because I think they were over 11 or 12% at one stage. Adobe had a fantastic Cyber Monday. The White House will continue pushing for extensions to the Israel-Hamas truce, which is fantastic news. A lot of hostages have been released and more to come. I think that's all fantastic. And the sooner that mess gets sorted out, the better. And then Britain has lost its appetite for UK equities. And this is super interesting. One reason is performance. Since the 1999 peak, the FTSE 100 is only up by 8%. 1999. We're now in 2024 just about. So 25 years ago, the FTSE has grown by 8%. Interesting. Anyway, and then a few other ideas on natural gas and stocks and so on. Well, I hope you enjoyed that. It was a bit of a messy sort of session, but I think it was more of a teaching session, more of something of interest, something that you can get your bite into, I suppose, and perhaps learn a little bit of something that you may or may not know. Nothing wrong with learning, by the way. I learn new things every day. And even though I've been in this business for 22, coming up for 23 years, there is still an awful number of things that people can teach me. If you've enjoyed this video, I'd love a thumbs up, and I'd especially love a subscribe. It's really difficult to get subscribers, and the more subscribers I have, the more views this channel gets, and the better content I'll be able to produce for you. Take care, have a fantastic trading day.